Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Welcome, everyone. This is Steve Meisinger, your host for today's ISE webinar. Today I'm really happy that we have Patrick Ceresno with us. Patrick is from optionsource.net, and if you want to, and a lot of you probably will, want to contact Patrick, you can go to optionsource.net. He and his partner, Jason Ayers, help investors with the uses of options, and really helping you understand your investments. So they say that they empower individual traders and investors. I'd urge you to go and check out their website. They do a lot of free webinars. They come on our program very often. They also do the weekly outlook, whether it's currencies or ETFs. So they do many things, try to educate all of us in the uses of options. Patrick is a great speaker. And so without further ado, I want to introduce Patrick Ceresno. Patrick, thanks for joining us here at the ISE.
Well, thank you very much, Steve. Can you hear me?
Perfectly clearly, yes.
Fantastic.
Just do a disclaimer, and then it's all yours. Just want to remind everyone that, of course, Patrick will not be giving any investment advice today. Any of the examples that he will be using are just examples, and that way he can illustrate the spread strategies. If you want to learn more, you can always go to optionsource.net. And just remember, taxes, margin, and commission are not included in any of the examples that he'll be using today. If you haven't gotten a copy of the characteristics and risks of standardized option, which I assume you have, you should go to optionseducation.org to learn more about that, to get that document, and you should really read it. And also, it's a great website, optionseducation.org. And again, taxes, margin, and commission are not included in any of the examples. Very important factors. Without further ado, I want to introduce Patrick Ceresno. Patrick, thanks for coming to the ISE again.
Thank you very much, Steve, and nice to hear from you as well. So yeah, we have lots to cover today in terms of wanting to utilize options within the overall process of trading. And one of the things that when we're talking about spread strategies, I just came back to the introductory page for a moment, is that first and foremost at OptionSource we are market timers. And when you're trying to actually forecast the market bottom or a market top, or trying to catch a directional trade, we want to use options as a tool. And options as a tool allow us to try to capitalize on what specific outcome we're anticipating for a particular strategy. And that's absolutely crucial. Now, spreads are a very important tool to use when in certain types of environments. And because one of the reasons we do that is because there's complexities involved in option pricing. And now, if anyone has gone and researched the Black-Scholes option pricing model and things like that, there's 6 major variables that are input into how an options price is actually determined. And I wanted to cover some of this in detail, including the whole idea of volatility in quite a bit of detail before we actually get to some real examples of spreads. The first thing that we need to cover is these 6 variables. Now, when you're determining what an options price is, the inputs are basically what the stock price is, what the strike price of the actual option, that's where you actually have the right to do business, to buy or sell an underlying stock. The third is how much time is left on that option. Number 4 is interest rates. The fifth one is dividends, and the sixth one is volatility, an adjustment for risk. I'm going to go into a little bit of detail on that volatility component because spreads are one of the ways of actually mitigating volatility, and we want to be able to utilize and understand that. Now, when I'm just going to quickly go to the next slide and then come back. I want to just point out is that what most people make this equation that if they believe a stock is going up, they just have to buy a call option and they'll profit from the stock going up. But the option price itself is actually continuously being tugged and pulled from a number of different variables in the process of option pricing. So if, let's say, you were right and you bought a call and the stock went up, well, if at that same time you were hit by time decay, a contraction of volatility, and you had a bad strike price selection, you may actually find that you didn't make any money on the call option because you didn't understand the way an option was priced. And so when we come back to this chart right here, what we want to talk about is how do we, knowing all of these variables, come up with an option strategy that will let us profit from what we actually anticipate. And we're going to talk about what different environments there are and how we can actually make decisions using spreads to actually mitigate some of the different variables. Now, what I wanted to just touch on before I get to the next slides was the fact that each one of these variables is actually, when we're talking about option Greeks, such as the delta, gamma, vega, theta, rho, all of the different variables that are in there. What each one of those variables is doing is trying to mathematically measure each one of these option pricing variables. So the delta is measuring things like the change in the stock price, while theta is measuring time, while rho is measuring interest rates, and vega is measuring volatility. Each one of these variables in the option price, the option Greeks, is trying to actually talk about how each one of these different variables is affecting things. Now, the one component that I want to talk about in a bit of detail is volatility. And volatility, when we talk about volatility, it's the adjustment of risk. Because if you take two stocks, and volatility was not a part of that math in that equation. And those stocks, let's say we took two $20 stocks, one like a defensive high dividend paying utility stock, while the other one is a high-tech startup company with that's very volatile. If the implied volatility was not a variable in the option pricing, then in fact, if they were both exactly at $20, barring that there was no dividend in that cycle, the option would actually be priced identical. The only thing that allows the one option to be far more expensive than the other is the volatility adjustment within there. And so the volatility, or the implied volatility, takes into account everything from like company earnings to pending announcements of mergers or economic market environment. If anyone saw that massive jump in the volatility index that occurred today based on that massive sell-off of the Nikkei, the whole market was feeling a little bit of shock, and then the volatility spiked, and that was really a economic, a macroeconomic kind of global asset kind of pop in volatility that never had anything to do with the very specific volatility of any one individual stock. And this volatility affects the way we have to pick pick our option strategies. And we'll talk about that in a little more detail. The one thing I just always want to mention is that there is a difference between historical volatility and implied volatility. I want to emphasize, if you took a stock and you looked at what the stock has done in the last 2 months, you're looking at its historical volatility. In the same regard, if the implied volatility is the market's forecast of what the volatility will be in the future, not in the past. I'll give you an example. If a company is on, in most part, do quarterly earnings announcements. So if the last 2 months there was no quarterly, there was no earnings announcement, but in 2 weeks there will be one, well, the implied volatility of the last 2 months would not be reflecting that earnings, but a new option that is actually going to be in existence over the earnings announcement is going to have a higher implied volatility, because that earnings announcement could actually have a bigger impact and create more volatility in that underlying stock. So implied volatility is not historic volatility, and that's something that's determined throughout the process. Now, just on a side note, there are a series of questions coming in. I'll address any questions at the end of the presentation, and this is being archived. So I'm just going to finish the presentation. I'll be happy to address any questions along the way. Now, so the next thing that we want to talk about, therefore, is that how is that implied volatility actually determined? Well, what happens is that when in the option pricing process, the market makers or whoever's pricing out the options actually just simply looks at it as one big probability distribution curve. In many cases, unless the volatility band is skewed, more often than not, market makers will price an option the same probability of going up as going down. Now, there are periods where the volatility band could be actually skewed, but in a lot of cases, it actually is quite equal. It looks sort of like a normal Bell distribution curve that is distributed along there from a standard deviation perspective. Now, if we take a $50 stock, you can see right in the center of the hump we have a $50 stock, and what we're doing is in this situation, determined by the implied volatility, one can determine, let's say, that one standard deviation higher or lower has a 34% chance of that being there. Let's say between $45 to $55, there's let's say a 68% chance that the stock will fall, let's say, over that given time frame within that $45 to $55 range. So an option is actually priced based on pure probabilities style pricing. And what happens is that if you think about it, a stock, a very volatile stock, can make very big swings higher or lower, which means that this bell curve has to be much wider. And I'm going to demonstrate that in just a moment. But in the same regards, not a very volatile stock will have a very narrow bell curve. So in this example, what we want to talk about is expanding volatility. Let's just say when we saw the VIX today, the volatility index, spike up the way it did. Well, what happened is that the option pricing is reflecting the uncertainty of the market. Is basically, and what's funny is the way that inverse relationship occurs with the VIX. But most often, the stock market drops much faster than it goes up, and therefore the volatility almost certainly has to be rather high during periods where there's a risk of a market decline, because they have to price in the fact that the stock can move a considerable distance during one of those market declines. And so just the way we saw that massive spike in volatility today, what that does is that it actually widens the curve. Now that increase in the volatility, increase in the volatility is measured by the option Greek called Vega, and the Vega is saying if the volatility increases by 1% or decreases by 1%, how much will the option price actually physically change in dollars? And so what I want to just demonstrate is that if we had the volatility index spike, this stock, the distribution curve would widen. So watch what's happening on this chart. But what's happening is that entire volatility curve expands. And while, let's say at the previous implied volatility, that there was that one standard deviation higher or lower was 45 to 55. Now that it's widened, that one standard deviation higher and lower might be $42 to $58. What's happening is that as the implied volatility on a particular stock is increasing, then the market is saying you have to pay more for this option because there's a greater chance that that it's going to make a very dramatic move higher or lower. And this during periods of expanded volatility, options become very expensive. So while let's say if you went back a month ago, or let's say even 2 months ago, buying a call or a put was relatively cheap. In fact, one could go out there and just buy a call outright or a put outright and make a very good trade with it because the option was not overly expensive. But now in periods where the volatility is expanding or increasing that way, what happens is that the option becomes worth that much more, and we have to find ways of reducing the cost of that option. And this is what I want to focus today on, is the idea of creating a debit spread in order to reduce the cost of an expensive option. When we know we're paying a big volatility premium for and one, let's say, that is much higher than it's been in the past, well, we might as well offset the cost of that expensive option by selling another expensive option. We'll get to the strategy in just a moment. Now, there's also periods of contracting implied volatility, and those are usually during bull markets. Like if you notice, over the 6 months prior to this whole little mess that started over the last few weeks, during this market correction that we're in right now, prior to it, we've had volatility that's been continuously declining. Right? Now, for many of you that may already be, let's say, covered call writers or put writers or do some sort of a strategy that way, what you'll see is that during periods of contracting volatility, like during bull markets, what you're going to see is the volatility contracting. So again, if you just keep your eye on the chart, what's happening during a period where the volatility index is declining, that curve actually is shrinking. Now it also goes down in the middle as well, and I just sort of had it just shrink the one way. But ultimately, what you'll find is that now the market makers are, let's say, pricing that option that there's only a one standard deviation higher or lower, might be between 47 to 53. What you'll notice is during very bullish periods in the market, unless you're, let's say, covered call writing on your ETF right at the money, as soon as you go one or two strike prices higher or lower, suddenly you're not getting any premium there. That's because the volatility has contracted so low. Now, really, the only place you find premium is at the money. During periods like this, doing spreads is not even necessarily important, but it's far more important during higher volatility periods that there's a benefit to that. So during periods of low implied volatility, one could just buy calls and put options because they're relatively cheap from a historical perspective. It doesn't mean that the market will move, but at least you're not overpaying for that call or the put. For option buyers, it gives an opportunity to position themselves in longer term trades for smaller costs. But for option writers, if you're one that's a big fan of covered call writing or put writing, you'll see that you more or less have to stay at the money or go to very volatile stocks in order to find any legitimate premium. You know, going 5% lower on the ETF becomes a very thin premium. Definitely on the bid side, you almost have to stay at the money. But during periods of high implied volatility, like the spikes we're seeing today and over the last couple of weeks, call and put options become expensive. And while we want to, let's say, try to call a market bottom, this morning in our trading room we were calling the market bottom right off the bat, and we were buying the initial sell-off. But the thing is that those options were very expensive. In order for one to benefit from that, you have to look at what it is that we want to try to profit from that. In that case, option writers such as cover call and put writers are actually getting very healthy premiums, even at or out, not only at the money but out of the money or even in the money. The point is that the option writers, the cover call writers and put writers get rewarded very well, but the option buyer is at risk of a volatility contraction. What I mean by volatility crash is that if the implied, let's say the VIX was at 30, and suddenly over the period that you're holding a call option, the volatility index goes from 30 down to 20. Well, what happened is that you're not, you might be making money off of the stock going up, but you're losing money off of the volatility contracting, and you're actually not even remotely profiting the way you should be because the volatility was actually contracting at the time that you were actually long your calls. Now this period of high implied volatility is where we want to learn to be spread traders, because they're volatility neutral strategies, and I want to talk about that a little bit right here. During periods of high implied volatility, we want to offset the cost of these expensive options, and it's ideal to consider debit spreads. We're going to talk about debit spreads, credit spreads, and callers today, and we want to start off with the debit spread. So the first strategy that we want to talk about is that offsetting the volatility cost during spikes in volatility, and the debit spread represents one of the best ways to do it. In fact, the debit spread is what we call volatility neutral, because when we buy one call option and instead of an expensive high volatility premium, well, we sell another, let's say, call at a higher strike price, but that was also at a very high implied volatility, so we're getting paid a bigger premium for selling that call. Now, the fact that we bought an expensive call but sold an expensive call, what we've done is that the volatility contracts, it contracts on both options, and therefore we're able to mitigate or reduce the risk associated with the volatility contraction, yet still profit from our market forecast. And that's the key thing, is that in periods where we, let's say, believe the stock will, let's say, go higher, but the options are very expensive, the debit spread is a very important strategy to utilize. So like we were saying, the debit spread offsets the cost of an expensive option. It reduces the break-even point on the trade. It reduces the potential loss if the underlying moves adversely, but you lose upside potential beyond the sold strike price. The best way to explain that to you is by actually using a real example. So what we're going to do is we're going to look at a real example using some of these ISC ETFs. So remember, the first type of a spread we're going to do, I'm only going to really do an example of a bull call spread, but I'll talk about what a bear put spread looks like and how you would build one as well. And so here, when you open a bull call spread, you must distinctly believe that this ETF is actually going higher. And in doing so, what we do is we buy a call option to try to profit from that upside move. But now, because that option is a little bit more expensive, we want to reduce the cost of buying that option by selling a higher strike call option to reduce the cost. So let's look at an example. In this example, we are using the natural gas ETF. Just so that we don't jump from one place to another, I'm going to be using that natural gas ETF as the primary one that we're using for our illustrative examples. And again, just like that disclaimer at the beginning, this is purely for illustrative purposes for people to be able to learn how to execute the strategy. So now let's just say this natural gas ETF this morning was trading at 21.25, and let's just say that one felt that it was basically oversold and that there was room for this ETF to actually rally. In that situation, we'd look at buying one April $21 strike call for 80 cents. That was the asking price. So now we have just about 5 weeks or so until the April expiration. So we paid 80 cents. Now that's now 25 cents of that 80 cents is intrinsic value because we're starting off with the stock at 21 and a quarter, but we're paying a pretty big premium. In the same regard, right now, we were looking for, let's say, the natural gas ETF to return to its previous high. The previous high on the natural gas ETF was around 22.5. So we would be looking for more around 22.5, 23. So we were looking for, let's say, this ETF to rally back up. So in this situation, we sell an April $22 call and receive 25 cents for selling it. So now now that's at the bid. So that means we paid 80 cents and we collected 25 cents. And so net of the two, it cost us 55 cents to open the spread. But recognize that the ETF is at 21 and a quarter. So we're already 25 cents towards our target. We only need this ETF to move another 75 cents over the next 4 weeks in order for us to be in a good and profitable situation with this particular spread. So now we have a $1 spread. So what I want to do is put the risk graph on actually that option. What we're looking at, the question online here is why not do a put credit spread? And we're going to talk about credit spreads and do an example of one just shortly. Now in the situation here, in the bull call spread, you can see the risk graph. Essentially, you can see that our downside loss is limited to the $21 area. At that stage, that's where our loss. We'll talk about the math associated with this example here. And what we'll do is that we have the upside up to $22. Now, at $22, it becomes capped, and no matter how much higher that ETF goes, you're not going to be participating on the upside. So really, we have a limited downside to the cost of the spread and a limited upside as well. So now our break-even becomes $21.55 on a debit spread. So now, under these circumstances, we basically long as the stock just rallies another 30 cents higher, we're going to be at our break-even point on the stock come its expiration, or on this ETF.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.isc.com/podcasts.